You are listening to Keystone Stock Talk Show, episode 235.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to be back with you again this week, discussing, among other things, the big news in the world of AI this week, as the CEO of OpenAI, the nonprofit company behind Microsoft-backed ChatGPT, was ousted only to be hired back by Microsoft. Sound confusing? Brett will sort you out. Aaron will take you to school with a snippet from our latest DIY on why Canadian investors require U.S. exposure in their portfolios. I will answer a viewer question on Titanium Transport Group, Inc., symbol TTNM on the TSX, a North American transport company with asset-based trucking operations and logistic brokerages servicing Canada and the U.S. The company, which pays a 3.42% yield, reported weaker Q3 earnings and updated its guidance. I will let you know if Titanium is a buy, sell, or hold. Last and certainly least, a man who is just days away from heading to Vegas for a punishing stag, Brennan, answers a viewer question on Converge Technology Solutions Corp., symbol CTS on the TSX, a software-enabled IT and cloud software solutions value-added reseller, which we have already answered questions on in 3 previous segments, but the appetite for info on is seemingly unquenchable. Brennan lets you know whether his previous take to avoid the business has changed. All right, let's get to the show. We welcome my co-host, Mr. Aaron Dunn, and the Killer Bees, Brett and Brennan. How are you guys doing?
Very well, thank you. How are you?
I just wanted to clarify something. Sorry. It's not your stag that you're going to. It is a friend stag. So, ladies, as hard as it may seem and believe, he is still Sigma.
Brennan is still
man
on
right
the
there.
market.
Somewhere.
But yeah, it should be fun. We're going to be going to a Golden Knights game against the Coyotes. I mean, the Coyotes aren't anything special, so it doesn't really matter. But we're also going to a Chiefs game against the Raiders. So I think that's cool. In other news, too, I mean, it's the new
in other news.
the baseball team, Oakland's baseball team now went to Las Vegas. So all of the sporting teams have basically left Oakland to Vegas.
It seems, why would you leave Oakland? That seems so strange. Why?
Anyways,
Vegas. Yeah. No, it's crazy, right? Yeah, it is. It is.
Managed in the movie
Bean?
with Brad Pitt, Moneyball.
Moneyball. Yeah. It's a good movie. But yeah, no, you should have a good time there, and we just hope you come back in one piece.
How many of your crew are going down there with you, Brendan?
There's 7 of us, and then 2 dads. But I mean, the dads are going to kind of do their own thing. The only reason they were coming with us is the guys ended up buying too many football tickets. Then they needed to resell the football tickets, and
why are the dads going to do their own thing? It's not like
I mean, some of the days. I mean, they didn't really want to go to a club and to Zed and just jump up and down with us and stuff like that. So
if your dad was there, he'd be going to the club, right?
Brent would not be going to the club.
He'd be up in the club, you know.
No, he would not be. But yeah, before we get into the show too, I'd like to toot my own horn a little bit here, as I do so often. So I'm just gonna.
We all want to hear that.
Screen.
I'm gonna plug my ears while you toot. Maybe my nose too.
Probably, yeah. You'll need to. So yeah, I wanted to do a little victory lap here on Vegano Foods, which, really I shouldn't be getting too much credit though, as, it wasn't too hard to see that the stock was a 0, even though, promoters were saying that it was potentially a 10-bagger. So a few months ago, I did a segment on a company after one of our listeners came across a very promotional video on how this stock could potentially be the next 10-bagger, as it will benefit from the explosion in AI. And I went on to rip the business apart and said not to touch it with a 10-foot pole. Well, in October, the company went under a cease trade order. So I went ahead and I sent a picture of the stock chart to VHLA Media on Instagram, and VHLA is who made the very promotional ad for the stock, just showing them that the stock went to zero after they had been promoting it. Now, they ended up firing back at me saying that it's not their fault I missed out on a 100% run after they highlighted the stock on their website. And, I won't give them much time here on the podcast, but all I can say is hyping up a 100% run while the stock ceased to trade just a few months later is nothing to be excited about. I also went on to rip them, just saying that it's gross that, they take money from these promotional stocks that go to zero just to promote them to lay investors. Anyways, that's my 2 cents. There's my victory lap. I'm glad that, no one that was listening to this podcast would have been buying that stock.
Not after listening to you, Brennan.
No,
Yes.
Brennan.
Yeah. I mean, that's just the classic to say. I mean, this is an extremely thinly traded stock, right? So to say, it went from 6 cents to 12 cents, that's a classic pump and dump as far as I'm concerned, right? It probably went up there very temporarily because of a lot of pumping. And, likely I didn't look at the volumes, but likely on very thin volumes. So probably the idea was that you get it up there and then these people that were pumping it just sell their shares out the back door and everybody else is left holding the bag.
Yeah, promoters will do what they will do. We're here about investing long-term in good businesses, and we'll check out the balance sheet, the growth of the business to see if it is something you want to put your hard-earned dollars in. I wasn't there on the show, but you guys looked at Vigano. The underlying numbers weren't there. That's why we wouldn't invest in a business like that. And, there's share trading going in and out of a stock, but we're trying to invest in good long-term businesses, and it just wouldn't make our criteria, so it would never be in our client portfolios. All right, let's move on. We have Brett. You're gonna handle some of the news of the week, and that was Sam Altman leaving OpenAI only to be hired back, and that is Microsoft backed OpenAI or ChatGPT, sorry, and only to be hired back by Microsoft, right? So how do we explain this? It was kind of shocking news that dropped, I believe, on Friday of last week.
Mm-hmm. Yeah, I'll go through the whole timeline of it. There's been quite a few moving parts, and it still has moving parts going on as we're recording this, and probably the following week we'll still see where the dust really settles. But it seems to be they've set their stakes where it's going to land, at least. So OpenAI, if you're not familiar, is a non-profit company. They're behind ChatGPT and DALL-E, which has they had a major change of leadership over the weekend. The CEO and public face, Sam Altman, was removed as the CEO of the company. This just comes weeks after the company's OpenAI's first Dev Day conference, in which they had a keynote where they went through introducing new models and products. And besides having Altman there being the face of it, they also had the CEO of Microsoft, Satya Nadella, on stage as well. So it's not like they were planning on pulling this guy when you're having him in the face for the company only a couple weeks prior at really the company's biggest event ever. So looking at the blog post that they released on the 17th or last Friday, Sam Altman was removed as CEO and the board of directors, and Mira Murati was appointed as the interim CEO. The blog post announcing the changes states that Mr. Altman departs follows a deliberate review process by the board, which concluded that he was not consistently candid in his communications with the board, hindering its ability to exercise its responsibilities. The board no longer has confidence in his ability to continue leading OpenAI. So they clearly don't want him there at that point with that statement. As well, in addition to Altman, Greg Brockman, the OpenAI's co-founder, stepped down as chairman, and he left shortly after. The push to out Altman was led by the chief scientist, Ilya Sutskever. I butchered that name completely, but I will put it on screen. Since the blog post, we've also seen significant changes, of course. Co-founder Greg Brockman, of course, he quit after. A letter to the board from over 500 employees of the company's about 770 employees asked for reinstatement of Altman and Brockman and the installment of 2 independent directors. And since that letter has been leaked by media, or I guess broadcast by media, upwards of 650 employees. So 650 of the 770 And that's over the weekend when people are asleep in different time zones. So clearly a large majority want them back. Notable signatories on that letter are Mir Muradi and even Ilya Sutskever, butchering his name again, the man who led the charge to remove Altman, who has since posted an apology on Twitter for his effort in the removal. A key excerpt from this letter from the employees: your actions, and this is directed to the board, your actions have made it obvious that you are incapable of overseeing OpenAI. We are unable to work it for or with our people who lack competence, judgment, and care for our mission and employees. We, the undersigned, so the people who signed it, may choose to resign from OpenAI and join the newly announced Microsoft subsidiary run by Sam Altman and Greg Brockman. Microsoft has assured us that there are positions for all OpenAI employees at this new subsidiary, should we choose to join. Like the letter said, Altman and Brockman were hired by Microsoft over the weekend. OpenAI and Microsoft had a large partnership since Microsoft's initial investment in the company since 2019, and they have since invested a cumulative $13 billion. Clearly, Microsoft disagrees with Altman's removal, effectively offering to take over the human capital of OpenAI. As well, now that Altman is under Microsoft, the very temporary interim CEO Muradi was replaced by Emmett Shear, the former CEO and co-founder of the now Amazon-owned live streaming service Twitch. Shear, in his 1 a.m. Monday post, mentioned that the board did not remove Sam over any specific disagreement on safety, so safety of AI and how it's implemented. The reasoning was completely different from that. So really, there's still no specific clarification on what the disagreement that led to Altman being removed is at this time. However, perhaps the most important takeaway for investors is Microsoft seems to have come out on top. They now have at least the leadership of the most influential AI products over the past year, and perhaps a significant amount of the employees coming there as well. Although Microsoft had a significant amount and still does have a significant amount of money invested in OpenAI, they never had direct control over the company due to how it is structured. So bringing the human capital really allows Microsoft to enhance their in-house research and development. And additionally, in Shear's post, and confirmed by Microsoft, he states that their partnership with Microsoft is still strong and still ongoing. So they're not even losing OpenAI as a external research and development firm. They are just gaining the staff, and then whatever OpenAI continues to do, they will as well. And that's really where our story ends for now. I'm sure there'll be updates. If there's any big, exciting updates, I'll probably update us next week on it.
Excellent.
Yeah, I think that it's
strange situation. I mean, it seems so sudden, and so, there's just really not any information that was provided on why. I mean, there are a lot of theories that are circulating around. One of the theories is that Altman wanted to push it more in the direction of commercialization, whereas Ilya, the chief scientist who apparently led the effort to remove him, wanted to go with OpenAI's original charter of, focusing on AI's benefit to humanity and not moving as quickly.
Or is it vice versa? Some people have it the other way, like, want the Sam on one side, the other side, right? Like wanting to limit.
So I think it was actually Sam that wanted to monetize it. And the reason being is because I listened to Elon Musk on a podcast recently, and he was very critical of Sam Altman because, I mean, Elon Musk helped found.
I think he did the seed funding, something along those lines.
He was one of the original board members.
Yes,
I think
exactly.
He actually wanted to. I could be wrong. I think he actually wanted to be the CEO, and they chose Altman instead, and that's the reason why he left.
And he's been very, very critical of Altman wanting to, make it a for-profit entity, essentially, where Elon's been like, oh, it should be non-for-profit, for the basically utility of everyone, of society, rather than just a for-profit company. And I was reading a Business Insider article as well. Musk told CNBC in May that he was actually responsible for Sutskever's, I'm also butchering his name, his hiring. So, is he taking Musk's interest in there by trying to oust Altman? I don't know. I'm bringing up conspiracy theories, but I mean, it's not an actual conspiracy theory, but
on Musk, so.
Yeah, exactly. But it is interesting. Was Elon in his ear saying, "Hey, oust him"? I don't know.
I mean, that's the thing, is that, like, we don't know. nobody knows anything. It just seems like extremely abrupt. And then in terms of that letter that employees signed, I mean, I had read that it was something like it was hundreds of employees, like 500
Yep.
employees or something. Well, there's only
It's
700 employees in
Yeah.
OpenAI, to my understanding. So that's like that's the majority of the company, essentially, right? So just seems like a very strange move. Without more, I mean, maybe they did have really good reasons, but you would think you would need a really strong reason to move that quickly and make such a major change. I mean, this is the CEO and board member, the chairman of the board and president, as well as a bunch of other key staff that left. But one thing is for sure, Microsoft is the huge winner out of this. I mean,
Oh yeah.
they still have their partnership with OpenAI. OpenAI needs them more than ever now. And they also are going to basically steal half of OpenAI's talent. So
Does
for
Microsoft
basically
need
nothing.
OpenAI eventually? You know, in who knows how many
That
years? I mean,
there's
obviously they're
talk
ahead,
about
but
that too,
you know,
right? So, Microsoft is a company we've had under coverage for, years as a core US technology stock, and we like their pursuits in the AI space. So this is just going to make it more of a thing.
I would say, can I add that I just believe that ChatGTP achieved sentience and overpowered the board and then fired Altman himself.
But that's actually
like
one of
itself.
the theories.
By
That is
itself.
one of the theories.
is that actually?
Of course it is.
Of course it is, yeah.
Yeah, of course.
That it was actually ChatGPT that instructed.
Oh, I didn't know that.
Altman.
Wow.
It was the hidden board member.
Another is that ChatGPT told Altman to fire the board. Anyways, we don't know. Nobody knows anything.
Good job,
so
Fred.
we're just we'll
Good.
Just have to see.
All right. Well, let's move on to Aaron Dunn's segment. Mr. Dunn, you're going to look at Canadians who typically, as we see, we look at tons of portfolios, talk to tons of Canadian investors. There's some underexposure to U.S. markets, and you're going to look at why they should have some exposure.
Yeah, certainly. And I think that this is, when we talk about giving the best advice possible to people in terms of building a portfolio and investing, I think that this is a big part of it. And where are you going to put your capital? There's always a bias. There's always a home bias wherever you are, whether the United States, Europe, Canada. There's a bias towards investing it in your own country. And in some cases, there's reasons for that. But particularly for Canadians, there are strong reasons to look outside of the border and down to our neighbors to the south. So this is basically what we're going to talk about is, as a Canadian, should you just keep your capital at home or should you invest in US stocks? Now, the United States has been a serial outperformer of Canada for almost all of the last decade. If we look over the past 10 years, in 8 out of 10 years, the US market has outperformed the Canadian market. So this is S&P 500 versus TSX Composite Index. Outperformed in 8 out of 10 years, but outperformed by a very large margin. So this chart here really just illustrates it every year, the excess return of the S&P 500 over the TSX Composite Index. So this is excess return. This is what it's producing in addition to whatever the TSX produced. So only 2 years here where the TSX outperformed, the most recent one being in 2022. What was the reason for that? Well, in 2022, energy had a very strong showing in the stock market, whereas technology had one of its worst years since the financial crisis in 2008, 2009. So this was the reason for 2022. Now, this outperformance has actually continued in 2023. So although Canada outperformed last year, don't get your hopes up, Canadians, that this is going to be the start of a new trend. Looking at the performance of the S&P versus TSX year to date, S&P is up almost 19% compared to the TSX's 4%. So, back again on another year of what's likely going to be a strong showing for the U.S. market versus Canada. So clearly, any Canadian investors who have not taken part in the U.S. market have missed out on a lot of return over the past decade, including in the current year. Return that they could have had if they had some form of allocation outside of Canada and into the U.S. Now, this is all historical information, of course, and we never want to just extrapolate historical information into the future and assume that this is going to continue to be true, assume that the United States is going to continue to outperform Canada by a strong margin over the next decade. However, there are some reasons why I believe that this is a structural problem for the Canadian market and why this outperformance will continue in the US, and therefore why Canadians need to look to the US market for at least a portion of their capital. So I'm going to illustrate that on the next couple slides, what this problem is. This slide here, this is the Canadian stock market sector weighting. So the Canadian stock market by sector. We're basically looking at 8 sectors: financials, resource, industrials, technology, consumers, utilities, communication, and real estate. And what we're seeing here is a very high concentration in the Canadian stock market to just 2 sectors, namely financials and resources. Now, resources, this is primarily oil and gas, mining. So these are cyclical companies. Long term, they do not generally perform well, a lot of volatility. And then financials, well, over half of this sector is just the big 6 Canadian banks, right? So there's a major over concentration into just a couple of sectors here on the Canadian market. But perhaps less obvious is, well, one, that even this over concentration is underestimated because a lot of the industrial companies, industrials being the 3rd largest sector, weighting at about 13% of the Canadian stock market, a lot of those service the resource industry. So we have about 30% of the market in financials, most of that the big banks, 30% in resource, which is primarily highly cyclical, volatile companies, commodity price driven companies, and then a good portion of the industrials. So over 60% really in these 2 sectors. Less obvious is where we're underrepresented, and that is in the technology sector. Now here we have technology at 8% of the Canadian stock market. But in reality, that's really kind of an overestimate in some ways, or at least if you look deeper and figure out like what our technology sector is comprised of. Because Shopify is a major percentage of the sector. I actually don't have the number right now, but generally like around half of our technology sector is in just one company. So underexposed to technology, overexposed to 2 other sectors. Now let's take a look at the US stock market by comparison. And right up at the top of the list, we have technology, almost 38%, about 28% of the US stock market. Again, this is actually probably an underrepresentation because some of the companies, some of the major companies may not necessarily be classified in the technology sector. Companies that are technology driven that we would consider to be technology companies. Apple is sometimes classified as a consumer product. Amazon can often be classified that way as well. But regardless, technology is the most important sector in the US stock market by far. And then beyond technology, we just see a better diversification across the different sector groups in the US market. So number 2 is consumer at 17%. Number 3 is healthcare at 13%. Now, we essentially don't really have much of a healthcare sector in Canada, which makes sense because we have single payer healthcare up here. So it's a completely different structure. But the US at least provides an opportunity to invest in that space. So really, technology being up at the top of the list is one of the most important things because when we look at the way the world is evolving, so much of this, I mean, it's really all being driven by innovation, or so much of it is being driven by innovation. Innovation, which is created by the technology sector, but doesn't necessarily just influence that sector. It's really influencing all sectors. So if we just look at artificial intelligence, which is the major theme in technology right now, or cloud computing, another major theme in technology, these technologies come from the technology sector, but really they're used to make all sectors more efficient, and create opportunities across the entire market, across the entire economy. So for us, technology is one of the most exciting sectors to invest in. And it's unfortunate that it just really has a minimal presence in the Canadian stock market. Now, going back to the outperformance of the US stock market versus Canada, when we talk to Canadian investors, probably the most common reason that we hear from them why they do not wish to invest in the US stock market is because they're concerned about the currency exchange risk. When you're invested in US stocks, you're going to have exposure to US currency. That's a concern. They see that as a source of risk. Now, we don't believe that that should dissuade somebody from having an allocation to the US. Now, once again, we're talking about an allocation, not all of your capital, just a portion of your capital. First of all, the US currency is the most important currency in the world. So having some exposure to it is probably good for your portfolio for diversification purposes. But even beyond that, we really think that for long-term investors, the currency exchange risk is really going to even out over time. In some years, it's going to help you. In other years, it's going to hurt you. But it's really going to even out over time. So it's not something that we would be concerned about, overly concerned about. There are ways to hedge the currency risk. We don't necessarily advise that for most retail investors, but there are ways to do it. But really, we think that it is not a good reason to avoid investing in US stocks. So I'm going to pull up the outperformance data again over the last 10 years, over the last decade, from 2013 to 2022. We have another chart here. So these blue bars, that's just the chart that we saw a couple slides ago. This is the outperformance of the S&P 500 versus the TSX. But these orange bars, this is the outperformance in terms of the nominal price change of the S&P 500, and in addition to the currency as well. So whatever you would have gained or lost in the stock market, plus whatever you would have gained and lost by having exposure to US currency. And what we're seeing here is that for the most part, things tend to even out. You actually would have been much further ahead by investing in the US currency over this period of time. But even putting that aside, in 5 out of the 10 years, the US currency actually helped you. It actually gave you additional return beyond what the S&P 500 did. And in the other 5 years, it went against you. But in only 2 out of the 10 years did it actually take an outperformance of the S&P 500 and turn that into an underperformance. There was really only 2 years, and that was in 2016 and 2018. So last year, even though the Canadian stock market outperformed the US stock market by about 11%, it really actually turned out to be only about 4% after we consider currency exchange risk. So even in years where the currency worked against you, you still were better off in almost every year to invest in the US. So we don't want to, again, extrapolate that this is what's going to happen going forward. Really, the point is to just drive home that not wanting to avoid the currency risk is not a reason to avoid having a portion of your capital in the US. That's just good diversification. Furthermore, the diversification and breadth of opportunities in the US is far greater than it is in Canada. There are types of companies you can invest in that you just don't have access to in Canada. So these are good reasons to look south of the border for some of your capital. Now, the question then is, how much of your capital should you allocate to the US market? This isn't really a question that we can answer because it really depends on so many investor-specific factors. I did provide a couple of guidelines. These are really just guidelines examples, but I would say for minimal allocation, the absolute minimum that really any Canadian should look to have exposed to the US would be about 15% of their portfolio. I think that's a fairly minimal amount, but it does give you some allocation down there. A more moderate or mid-range amount would be about, 25, 30% of your portfolio. And then if you wanted to get more aggressive and have more exposure to the US, for some people, you could have 50%, even 60% focused on the US. And in some cases, even more. But that really just comes down to a lot of investor-specific factors. And that's not a question that there's no one answer to that question that's going to apply to everybody. So that's something that people have to figure out for themselves. What is important, though, is that the allocation be greater than zero and that investors not be dissuaded by the prospect of currency exchange risk.
Yeah, excellent. I mean, To me, it comes down to the, like you said, the breadth of companies. I always tell the story when we do our webinars, when people ask questions about investing in the US. Why invest in the US? You get a question like that. And we can give you an example. 4 or 5 years ago, when we thought cybersecurity was a major investment theme going forward, would be for 5, 10, 15, 20 years. We did a survey of the Canadian markets. Look, there was about 4 to 6 companies. None of them were profitable. BlackBerry was one of the companies we looked at. Didn't want to invest anywhere near that company. And but when we do the similar search in the US, we found about 60 companies. And we were able to narrow down a number of profitable businesses and go with a business that has given us exposure and has had tremendous gains in that sector over the last 3, 4, 5 years. We couldn't even have had that exposure, even if we identified the cybersecurity market as an area we wanted to be involved in. Could not gain exposure to that market through the Canadian markets. If you look to the US markets, 10 times the size, more technology, we could find a business to invest in that we felt comfortable in. And we're able to have our clients benefit from that. So that's just one real world example of why you can look down there and diversify and get in on some sectors that have great gains over the long term. All right, you guys got nothing? Let's move on. All right, Aaron, I think you said your piece on that one. So let's move to Titanium Transportation Group, your stock, our take. I'm going to share my screen here. Just give me a second.
Can I play the
to
song
do that?
Titanium?
You can do that. Please do.
We'll get demonetized, or not even. We're not even.
Oh, that's right.
We'll just get kicked from YouTube.
Yeah, you're right. Copyright.
All right, let's go. Titanium Transport Group, symbol TTNM on the TSX. Let's go back there. Hold on. My mouse isn't working properly. There we go. Trades at around $2.32. Market cap is $103 million. Dividend is 3.42%. They are an asset-based logistic and trucking company that services over 1,000 clients, mainly in Ontario and adjacent regions. The company is a leading industry consolidator. It's done 12 acquisitions since its inception. Operations include cross-border truckload services, Canadian and U.S. freight, logistics, and warehousing and distribution services. Let's look at their Q3 results that were out last week. As we can see here, revenues dropped about 1% to $111 million. EBITDA was lower at $13.5 million compared to $15.5 in Q3 2022. Their EBITDA margin was lower at 13.6% versus 16% in the same period last year. The truck transport segment was actually up to $62.4 million compared to $54.9 million, but logistics was down to $51.5 from $59.6. Diluted net income per share showed here at 4 cents per share versus 5 cents in the same period last year. However, when you normalize those, last year's was about 14 cents. So on a normalized basis, net income was down roughly 71% in the quarter. So let's look at some highlights from the quarter. They completed a strategic asset-based acquisition of Crane Transport out of Oakwood, Georgia, adding 200 trucks, 2 strategically located terminals in Georgia and Alabama, and approximately $60 million in top-line annual revenues, further expanding their North American footprint. They announced their 7th U.S. freight brokerage office was launched in Jacksonville, Florida as well. There's management comments from the quarter here. During the third quarter, our industry continued to face significant headwinds, including adverse economic conditions, soft demand, and overcapacity. That's from the CEO. And their guidance came out for the full fiscal year this year, 2023, about expecting consolidated revenue of $430 to $450 million, adjusted EBITDA margins from 10.5% to 12.5%. Give you some context here of that. This is essentially they lowering guidance. A sluggish freight environment caused the company to lower its annual revenue guidance to $430 to $450 million from $450 to $470 million, where it was previously. But the company is maintaining its EBITDA margin assumption of about 10.5 to 12.5% on lower revenues. So let's look at valuations. The forward-looking EV to EBITDA is 5.5 and the PE of 10. It appears attractive, but EPS is expected to be significantly lower. The estimate is around 23 versus 55 cents last year. So let's look at our take here. Lower CapEx in fiscal 2024 and 2025 is expected following 2 years of heavy CapEx, a replacement cycle, particularly exacerbated by delays brought on by the pandemic. Management noted on the call that they do not anticipate further purchases of trucks over the next few years. Their average age of the fleet now is 1.6 years, so that's quite low, and they have caught up with the trailer replacement cycle that they were in. CapEx is expected, for some context, at $14 million over the next 2 years versus $77.8 million in fiscal 2022 and an estimated about $55 million in this year. Given lower CapEx spend, management anticipates stronger free cash flow generation over the next 2 years. In our opinion, however, though, with debt expected based on this year's expected EBITDA, that should say in the range of 3.5 times, the company will need that free cash flow to begin paying down debt more aggressively. This will be a priority. If we look at 10-year revenue growth on the business, it's fairly strong. You can see here, strong, consistent track record of growth. However, you can see in the last 12 months, it's been trailing off. So we see the final point here would be limited growth organically, particularly in the near term. Fair value, it's trading in a fair value range right now. It's about fair value. There's higher risk with a business like this in a recession. And that's how I'll close off on Titanium.
It's an interesting company. We actually met with the management team down in Los Angeles at the Roth conference, and there's a number of companies in the trucking and logistics space that we do cover. But interesting though, for the first 3 quarters of last year, the industry had tremendous results, which was largely due to price increases and just demand outstripping capacity due to the supply chain issues. But then it changed very quickly from being a situation where there was lack of capacity and too much demand to the exact opposite. And we didn't make any recommendations in that space, even though there was a couple companies, Titanium, Mullen as well, that we were following closely, because looking at the conference calls and then talking to management, it was quite evident that after the big push with respect to increases in prices, that the situation was softening, and I would expect that prices have actually come back a little bit since then, in addition to lower volumes.
Yeah, and the valuation right now just seems fair. If you're not going to have much organic growth, it's only going to be led by those acquisitions.
Maybe
plus
long
the
term,
fact
it's interesting, but
there's some leverage here, so I wouldn't expect any acquisition in the near term. They're going to need that free cash flow to start paying down debt. Again, as we say with many of these companies, debt's more expensive now. So you can have some EBITDA, but that interest expense is real there, and it's squeezing profit margins on a lot of these businesses. So we'll continue to monitor. Certainly not a terrible company, but we'll continue to monitor Titanium. Brennan, before you head out of town, do you have one segment in us before we see you pictured all over your Instagram or whatever you kids are on, saying, "Oh, Vegas, baby, look at me." CTS, we've talked about this company at least 3 times in the past on the podcast, and you're going to talk about it again today.
Okay, so yes, this question came in from James via email, and he says, is Converge Technology a buy now that it is growing revenue and earnings? So Converge Technology Solutions, CTS on the TSX, currently trading at a price of around $4.12, market cap of $813 million, and a dividend yield, which is forward, of just under 1%. So Converge Technology is a software-enabled IT and cloud solutions value-added reseller, which is focused on delivering advanced analytics, application modernization, cloud, cybersecurity, digital infrastructure, and digital workplace offerings to clients in various industries. Now, we have covered Converge technology several times on the podcast now, and I've kind of shown up on the screen here the fundamentals each time that I looked at it. So the first time was in October of 2020, the second time was in March of 2022, and the last time was May of 2023. And every time my conclusion was essentially along the lines of the business having great growth driven by acquisitions, which was funded by both debt and equity dilution, but the stock had very thin margins, which made it difficult to justify gaining a substantial EBITDA or price to cash flow multiple. So I'll just quickly pop this up on the screen. This is where they are located, or their locations are. A few years ago, they moved into Europe as well. Looking at some company updates. The last time I discussed the stock, management had concluded a strategic review process to evaluate a full range of alternatives where they were looking at potentially a sale, a merger, divestiture, recapitalization, or other strategic transaction, as well as just potentially continuing to go as an ongoing entity, which is what they ended up concluding to do. So they were just going to do that going forward, of course. Now, recently, the board of directors also authorized the initiation of a quarterly dividend of 1 cent per share. And the company also has been buying back shares under their NCIB, where I've actually included, if you look at the chart on the screen, they haven't issued any new shares since 2021 and have been slowly reducing the count there. Now, it may also be worth to mention that the company is also integrating a new ERP system by the end of 2024 in North America and then in 2025 in Europe, which they believe will help increase margins. I don't know. We'll see if that actually transpires. And as well, in the company's Q1 conference call, management indicated that they were pausing on acquisitions to focus on integration, cross-selling, and cash generation. So seeing that the last quarter reported was actually Q3 and their last acquisition was closed late of last year, 2022, the Q4 results upcoming will primarily be just organic growth. So we'll be able to see there. Now, actually moving over to the financials. So like I said, recent financial results for Q3 of 2023, net revenues were up 38% to $710 million compared to the same period last year. Now, gross sales organic growth was 24% year over year, but keep in mind, this is organic growth of gross billing sales as compared to the actual net sales that Converge brings in. So I included there just a table that shows their organic growth on the quarterly as well as the year-to-date numbers as well. Now, adjusted EBITDA increased 33% to $41.3 million, and that's an adjusted EBITDA margin of about 5.8%. GAAP EPS was a loss of 1 cent in the quarter, and adjusted EPS was flat at 10 cents per share compared to the same period last year. Now, the reason for the decline in profitability margins was due to product mix from higher hardware sales during the quarter, as well as several of the acquisitions completed last year are high volume, low margin businesses, is what the management said in their conference call. Now, the company now has net debt of $307.5 million and a trailing net debt to EBITDA multiple of about 1.8 times. And over the last 9 months, they're paying about 7.4% interest on that debt. And this compares to about 5% same time last year. And looking at the valuations, they're trading with a trailing EV to EBITDA of just under 7 times and a price to cash flow multiple of 5.6 times. Now, the company also provided adjusted EBITDA guidance for Q4 of 2023 of $46 million at the midpoint, which will equate to about 7% growth year over year. But without any net revenue guidance, we are in the dark essentially on what the adjusted EBITDA margin is anticipated to be. However, something that I find interesting is that management references that it targets a 30% adjusted EBITDA to gross profit margin. So over the next few years, rather than a typical adjusted EBITDA margin, they're looking to get to this adjusted EBITDA to gross profit margin of 30%. And if we look at this most recent guidance, that place for Q4, that places them at this margin of 25%. So, I find it weird that they're quoting that rather than just a normal adjusted EBITDA margin. So moving on, just quickly looking at GAAP net income to adjusted net income. I did this last time in May, but let's do it again just to see how the company is adjusting its net income. You can see that every quarter the company is adding back significant acquisition, restructuring, and other related expenses due or related to their acquisitions. Now, personally, I think that adding back these special charges may be a little suspect, as the company is consistently making acquisitions and incurring these costs. So, it's expected to go forward, essentially. So, to conclude, now revenue growth has been tremendous, driven by an aggressive cadence of acquisitions, but in the near term, management plans to slow down on acquisitions and focus on integration. Essentially, we have seen the company go from significant net debt to then issuing shares to improve the balance sheet and then get back into a net cash position. But now the company is back into a significant net debt position, with net debt of about 307 million and a net debt to EBITDA multiple of about 1.8 times, which the last time I covered it in May, it was 2.1 times. So it is improving, which is nice to see the company paying down its debt and growing its EBITDA and continuing to not issue shares, essentially, and buy shares back. But I still think that they've got work to do on that balance sheet. Now, the company also pays a dividend yield of under 1%, which equates to an outflow for the company of about 8 million a year. Personally, for the ever so slight yield, I think I would rather the company just continue to pay down its debt or utilize it for acquisitions, so that it doesn't have to dilute in the future. So, some people might like the dividend. I don't know if I like it that much. As well, looking at the valuation, the company trades with an EV to EBITDA multiple of under 7 times, but adjusted EBITDA margins and net profit margins continue to be very thin, and management has voiced that they anticipate to increase them for several years now, and we did see them increase over 2021, but that growth in margins has kind of stopped around that 6% mark. So to answer your question, James, on whether it is a buy right now, it continues to be a company which we simply monitor and not a name which we would recommend to our clients.
So for some people wondering in terms of, the nature of their business, as Brennan said, they're a reseller,
Mhm.
right? So essentially like a distributor. So they don't have their own technology. They're not selling their own projects or products and services or developing their own technology. They sell other people's technology essentially, and that's why the margin is so low.
Yeah,
And
great point.
it is that industry is characterized by lower margins. And I also noted that their margins were actually down compared to the previous year. So they're already low
That's what
margin.
I was going to say,
Yeah,
honestly.
they've
Like
come
they're
down.
Yeah.
Sorry for stealing your thunder there,
no,
Brian.
no, no.
But,
But it like I don't know if you had more, but it's always been a story about increasing margins over time. And we
mhm.
just look at the last quarter, and on an adjusted EBITDA basis, on an adjusted net income basis,
Yep.
margins were down again. So again, show me you can actually increase, because like they're low. If you can increase sales, but your margins are going down, there's not much a point to the business, to be honest. I mean, I get you can generate cash flow, but we talked about low margin businesses in the office over the course of the week. One thing we like is low to or just good cash positions in those businesses, but this company doesn't have that either, and it's just I would like a higher margin, or at least to be inching those margins up, because that is what this company has said they stated goal as they went public, and to consolidate this industry is to achieve higher margins over time. We see lower margins at present, quarter over quarter.
Yeah, like you just looked at a
or
trucking
year over
company
year. Sorry,
with adjusted EBITDA margins of, what was it, 12% on titanium transportation, something like that.
Mhm.
This is a technology company with EBITDA
Well,
margins.
no,
And
there.
even
I mean,
12%
I get it.
EBITDA
They're not,
margin's
but
not,
yeah,
I get
12
it.
is
it's not
But
that great. But
no, but
when you're
just
talking like
comparing.
the 5-6% EBITDA margin and you have debt,
Mhm.
so your
yeah.
interest payments come out of that before you get to your net profit, right? So they're reporting negative net profit, but then positive on an adjusted basis, right? It's we just had an interview with a CEO of a company it's also a low margin business, but it was a net cash business, and he was talking about how, given that it's a low margin business, he didn't think that there is any room for debt in the capital structure, and
Yeah.
we agree because
We agree more with that philosophy,
mhm,
right?
Yeah.
And
I mean,
in
if
this
you're
case,
already producing tiny margins and then, the rates go up like they have in the last year, I mean, you can go from, being profitable to losing money quite quickly. So,
yeah, yeah. It's a good point. All right, I think we'll end the show off there this week. Thank you for sending your questions in to our Your Stock, Our Take segment. If you're viewing this on YouTube, keep those questions coming in. If you're viewing it, smash that subscribe button. If you're listening to us on iTunes, rate and review us on there. Like I say, only positive reviews. And as always, I'd love to wish you profitable investing. Thank you.
thank you.
Thanks, everyone.
Thank you.